Welcome to the Option Guy. Today, we are kicking off with one of the most popular option strategies in the world, the covered call. It's simple, powerful, and used by traders and investors everywhere to generate extra income from the stocks they already own. Think of it as a way to turn your shares into a money making machine without selling them, of course. And don't worry, I'll explain it step by step in plain language with real examples so that by the end of this video, you'll know exactly how to use it yourself. And here's the best part, this is just part 1. In the next video, we'll tackle its equally legendary cousin, the Iron Condor. But today, buckle up because once you understand the covered call, you'll never look at your portfolio the same way again. Option strategies sound complicated, right? Covered call, iron condors sounds like a rocket science. But here's the deal. If you can explain it to your pizza delivery guy, you can explain it to anyone. So, in this video, we'll break it down in the simplest way possible. No boring textbook talk, no Wall Street jargon, just clear, real life examples. Because if you can understand how to order a pizza, you can understand how a covered call works. By the end, you will see that this stuff isn't complicated at all. It's actually pretty awesome and profitable once you get it. Here's the thing most beginners get wrong. Options are not just random trades, they are strategies. Think of it like chess. You don't move piece aimlessly. Every move has a purpose. Defend, attack, trap, win. Options work the same way. A covered call isn't just about buying or selling a call. It's carefully planned strategy. You give up some potential gains in exchange for steady, predictable income. That's the trade-off, that's the strategy. And just like in chess, once you understand the rules, you can start planning smart moves that puts the odds in your favor. So what exactly is a covered call? It's simple. You own the stock and you sell a call option on that stock. That's it. The word covered means you already hold the shares. So if someone decides to exercise the option, you are covered. You can hand over the stock you already own. No panic, no scrambling. Think of it like you own 100 shares of Apple at $180. You sell a call option at $190 and instantly collect a premium. You still own your Apple shares, but now they're also earning you extra income. That's the essence of a covered call. Own a stock plus sell a call, which is equal to income on top of your holdings. Alright, let's look at the first scenario. Suppose you sell a covered call with a strike price at $55. If the stock price stays below $55 by expiration, nothing happens. The option buyer won't exercise. Why would they buy at $55 if they can just buy a cheaper in the open markets, right? So you keep your shares and you keep the premium you collected when you sold the call. The premium is yours no matter what. See, for example, you own 100 shares of Microsoft at $50 and you sell a $55 call for $2 per share. If Microsoft never crosses $55, you pocket 200 premium plus you still own the shares. This is the beauty of the covered call. In flat or slightly up markets, you are making extra money on your existing holdings. Here's the easiest way to think about a covered call. It's like renting out your house. You still own the property, but you are collecting rent every month from someone who wants the right to use it. With a covered call, your stock is the property and the option premium is the rent. You don't give up ownership, but you earn steady income while you hold it. See, for example, you own 100 shares of Apple at $180. You sell a $190 call option and collect $300 from it. That $300 premium, think of it as a rent you just earned while still holding your Apple shares. That's why so many long term investors love covered call. It turns the stock portfolio into cash generating machine. Here's the real trade off with a covered call. On one hand, you get steady income. That's the premium you collect is like rent. reliable, and repeatable month after month. It can add up to a significant return even if your stock doesn't move much. But on the other hand, you give up the unlimited upside. If the stock suddenly takes off like a rocket, your profit is capped at the strike price plus the premium. You don't get to ride all the way up. Example: imagine you own a Tesla at $200 and sell a call option at a strike price of 220. If Tesla jumps to 300, you will have to sell at 220 plus the premium, missing the extra 80 rally. So the trade is clear, limited upside in exchange for steady income. Here's what the payoff of a covered call looks like. Notice this. If the stock prices rises, your profit increases, but only up to a point. Beyond that strike price, your profit is capped. That's the trade-off. On the other hand, if the stock price falls, you start losing money, but the premium you collected cushions some of that loss. Example: Tesla at $200. Sell a call option at a strike price of 220 for $5. If Tesla goes to 220, your max gain is locked. If Tesla falls, your $5 premium reduces the pain. This chart highlights three key points. Number one, premium income. That's the green dotted line, and it's what you collect upfront no matter what. Number two, capped upside. Once the stock crosses the strike, your profit stops rising. Number three, downside risk. If a stock falls sharply, your losses can continue. But again, the premium you received offers a small cushion. Example: Microsoft at $300, you receive a $5 premium. Even if the stock dips to 295, you are break even. Here's the most important calculation: your break even. It's simply the stock price you bought minus the premium you collected. If you bought the Tesla at $50 and sold a call option for $2, your break even isn't 50 anymore. It's $48. That's two premium acts like a discount on your cost price. So now let's answer the question. When do covered call works best? They shine in flat or slightly bullish market. When the stock is moving slowly upward or sideways, you keep earning premiums without the risk of your shares being called away too often. Alright, let's wrap up our deep dive into the covered call strategy. But this is just the beginning. In the next video, we are going to break down another legendary strategy, the Iron Condor. After that, I'll take you inside a real world covered call example. We'll actually enter into a dummy trade together and track it step by step, profit, loss, everything. So we will see exactly how it works in the market. So make sure you stay tuned because you don't want to miss that. If you enjoyed this video, don't forget to like, tap subscribe and share it with your friends. It's really helped the channel grow. Thank you so much for watching and I'll see you in the next video.